Okay, class, this is our video lecture for chapter number 2. We'll probably have 2 videos for this chapter where we're going to learn how to calculate cost recovery, or what you learned, the terminology in your previous accounting classes is depreciation. Remember that straight line and declining balance method? Well, we're going to first calculate our cost recovery for assets. Remember, assets are things we own that have current value that's going to be used up in the future. And the cost may already be used up, so we would maybe classify that cost as an expense. But as we start to use up these assets, we're going to convert the asset into an expense. So we call that again depreciation. But the term depreciation applies to assets that are tangible, physical assets, except for land, right? We don't depreciate land. But here in chapter 2, we're also going to use up intangible assets like patents, copyrights, um, licenses, and we're going to amortize those intangible assets. So that'll be in the second video. What's not common to Hawaii are assets that are natural resources that are used up. But if we do have them, we're going to deplete them. Yeah, depletion. So setting up the asset, and as it's being used, we convert that into an expense. So we got to learn this calculation of converting into an expense. So this first video will focus on tangible assets being depreciated. And the main calculation, the bulk of the chapter, deals with a method of depreciation called modified accelerated cost recovery system, or it's pronounced MACRS. I remember before this modify, we had just acres, and then in 19, I believe 86, they modified it to make it even more advantageous to taxpayers to get a bigger deduction. So we'll learn this calculation for MACRS again for most of this chapter. But another type of depreciation is called Section 179, or immediate expensing. This section is a paragraph or a part of the Internal Revenue Code, and this type of deduction allows you to claim, at least for 2018, $1 million of assets that you buy during the year. And for most small businesses, they don't buy $1 million worth of depreciable assets. So, but they can probably write off the whole thing with this Section 179 deduction. And in addition to 179, there's also another type of depreciation called bonus, which for 2018 and the next few years is also a big amount. How big can you get than 100% depreciation? Now, the order you apply these 3 different methods of depreciation is that 179 is the first you utilize, then bonus is the second, and this MACRS is the third method if anything is still left over to depreciate. But again, most people don't get $1 million worth of assets, so probably you won't even reach this bonus step for many businesses. Our textbook says probably this is the preferred method, but again, most businesses don't buy $1 million worth of assets. Okay, but if you do, then maybe this bonus will come into play, and then the MACRS will come into play. Now this rule here is 100%. It's eventually going to phase downwards over the years. Probably in 2022 it starts to go down, and then maybe the MACRS will kick in again. Yeah, but for whatever reason, I guess it's just tradition, that our textbook focuses on MACRS a lot, this calculation. So let's take a look at an example. We have Scrap Happy, a scrapbooking retail chain that bought an office building for 175,000, keeping in mind that there's no land costs in this 175, so we're going to depreciate the whole thing. Now, to get this building ready for use, they spent 15,000 on painting and remodeling. Again, this is for the initial use. So what you got to do is add up all the costs to get the property ready for use and treat it as one big asset. We're also told that there was some damage with the leaky roof and they had to repair that roof by spending $50,000. That's 2 years after they got the building. And then every 6 months they spend 500 to clean their carpets. So the question is, how much do you have to treat as an asset? Sometimes we call that capitalize. And then how much can we deduct or depreciate? We'll first take a look at how we treat this as an asset or not. We're told that the initial cost plus that cost to get the asset ready for use, all of it will be treated as one big asset. Now, keeping in mind, we don't start depreciating the asset when we buy it. The key date is when we start to use it in the business. Okay, so this 190,000 is a asset. So how about the $50,000 spent on the re-roofing? This is 2 years into buying the building. Well, you know this 50,000? This is a new building asset. This is our old building asset. We're going to see non-residential real property is going to have a life of 39 years. So this will be depreciated over 39 years. And 2 years later, we'll start to depreciate this part of the building for 39 years. Even though maybe this is a very old building and it's not going to last 39 years, the tax law says we gotta depreciate each building, non-residential building, over a 39-year life. And it makes it more objective, at least in the calculations. And we don't have to guess how long something's going to last. We don't even take into account any salvage or scrap value. In the case of the $500 that is spent regularly every year, this is not a capitalized cost, but a regular operating expense. So maybe even if this painting had happened a few years later, not getting the building ready for use, but just regular maintenance, we can probably deduct this right away, again, if it happened later on. And it can get quite questionable in terms of what is maintenance, like this 500, and what is a major capital improvement that has to be treated as an asset and depreciated. Again, we're learning the modified accelerated cost recovery system first, where we need to determine how much to depreciate. Here they call the word basis instead of the word costs. And then what's the calculation? So you guys remember straight line method, right? And declining balance method. And I even remember something called sum of the year's digits method and the units of activity method. The most common method for tax purposes under this maker's rules is the double or 200% declining balance. We'll see variations of this maybe using straight line or units of activity also. We'll also have to determine what is the so-called class life of the asset. And it's pretty subjective. You don't have to guess what the life is. If it falls within a certain type of asset like equipment, automobile, computer, it's going to be assigned a life no matter how long you think it's going to last. Whenever you hear the word convention, there's a special calculation for depreciation in the year that you get the asset, buy it, acquire it, and in the year you dispose of it. Okay, so convention is not like the conference convention where you hear music and people speaking. Convention just means rules. The rule, special rule when we acquire the asset and when we dispose of the asset. What's the additional calculations we have to do? We're going to depreciate tangible things we can touch property. And property that's not real estate is called personal tangible property. Don't confuse the word personal here with personal use. Personal use here means non-business. This here is business type property that we're going to depreciate. So you know your personal automobile, the computer you use for school. We don't we don't use that in our depreciation calculation. We're using just business assets to be depreciated. In this case, ones we physically can touch. That's not real estate or real property. The most common method for depreciating personal tangible property is using this double declining balance method. And we don't have to actually do all the calculations because there's going to be a depreciation rate or rates built into a table, and we just pick out the percentage for the table and multiply it by the cost basis to get the amount of annual depreciation each year. There's also tables for 150% and straight line rates. Most of these tables, if they're not within the body of Chapter 2, they're located in the appendices at the end of that chapter. You guys learned depreciation for financial accounting in previous accounting classes, but probably the dollar amount you figured out in these classes cannot be used on your tax return. You gotta use tax rules. You gotta use the MAKE rules, that's Section 179 and bonus depreciation rules, and not financial accounting rules. Now, when you prepare financial statements, especially that income statement, you're going to have to eventually match it up with your tax return, and both have depreciation deductions, but the dollar amount is not the same. So the tax deduction here and the tax liability here are going to be different. So because you owe a different amount than what you're deducting here, we're going to find out there's another chapter, another topic during the semester called accounting for income taxes or deferred taxes. Okay, so that's a future chapter we're going to look forward to covering. Okay, so we need to determine um, what category, again, the class life that the asset's going to fall into. So here is a bunch of different categories. For example, office furniture, fixtures, equipment fall into this 7-year life. Common one is computer and peripheral equipment for the computer falls within 5 years, and most automobiles fall within 5 years. You can see the common ones here. There's like 10, 15, 25 year, but the common ones are 7 and 5. So for most assets we come across, most personal property can be just used in this short table here. Again, a 5-year category and a 7-year category. If you're like me, I probably replace my computers more often than 5 years. But this is the law. You gotta depreciate your computer equipment over a 5-year period. Here's that word again, convention. The special calculation for the year you buy the equipment and the year you dispose of the equipment. In the year you purchase the equipment, start using it, you're going to be assumed to have used it for half a year. Maybe you could have bought it in January and used it for 12 months, or bought it in December and just used it for 1 month. The convention we use is called half year and assumes that you bought it right in the middle of the year, and you're only going to take 1/2 year's worth of depreciation for the first year. And that means at the end of the 5 or the 7 year period, there's going to be another half year's worth of depreciation to come out with a total of 5 or 7 years. And again, all of these depreciation calculations is built into percentages in a depreciation table that we'll see. Now, if you buy a lot of the personal property in the last quarter of the year, that's October, November, December if you're using a calendar year. When you buy a lot, meaning more than 40% of your personal property during the year is bought in this last quarter, then you cannot use that half year convention. You're going to use something called a mid-quarter convention. So let's say that this timeline here represents your whole calendar year, and here's the first quarter, second and third and fourth quarter. So here's that last fourth quarter. If you buy more than 40% of your assets for the whole year in this fourth quarter, then you got to use this mid-quarter convention. Meaning now, for this first quarter, whatever assets you bought during this quarter, you're going to assume you bought it right in the middle of that quarter. I guess that's February 15th, and you depreciate it to the end of the year. And anything you bought for this second quarter, let's see, April, May 15th, you assume you bought it this date and you depreciate it to the end of the year. Likewise for the third and the fourth quarter will be depreciated only for 1.5 months. That's when more than 40% of your personal asset, personal property was bought in this fourth quarter. Otherwise, the default is assumed to have that a half year convention where everything is depreciated in the first year for half a year. So here's a summary of how to go through that calculation. Yeah, you calculate out your basis, you determine whether you're using the half year or mid-quarter convention, you use the proper percentage in each table. And if for whatever reason you dispose of an asset early before the fifth year or that seventh year, the tables are not built for that disposition. So you have to probably do a special calculation for that last year you own the asset. So here is our depreciation table for the half year convention. Again, we're focusing on 5 and 7 year property. So all the property you buy that falls within the 5 year category, like your computers, you're going to take 20% depreciation in the first year, 32% in the second year, 19 in the third, and notice it starts to drop off. You notice it's same here, and this last year is half of the previous year. Likewise, notice how it's same. You would think the declining balance would get smaller. What happens here and here is that the depreciation rate of calculation changes from double declining balance method to straight line. And the straight line calculation is not based upon the original cost, but the remaining book value or adjusted basis at the end of these periods here to the end of the life. And again, the last year would be a half year of the previous straight line. So if you total up all the years, how much should it come out to? Right? We don't have any salvage value to consider for tax purposes. Okay, so once you identify the class life, you got to stick with that column for each year. Now let's say that here in year 4, you dispose of the asset. Well, this is a full year's worth of depreciation. The half year convention says you got to take half of this. No matter when you dispose of the asset under the half year convention, you take half of this amount for that last year of the asset you're getting rid of. So here is the table for the mid-quarter convention. You have 5-year first quarter, 5-year second quarter, 5-year third and fourth, and the other is for the 7-year property, all 4 quarters. And again, if you buy more than 40% of your personal property during the year, here in the fourth quarter, you gotta assume each quarter you're gonna take this amount for the first, this amount for the second, this amount for the third. That's for the first year. And the second year, you just drop down to the next row for that class life. Example, scrap happy again. We're buying two different assets with two different class lives. This machine is 7 years and the computer is 5 years. So if you add up the total costs, notice the quarters year you're buying it in, yeah? If you add up the total cost for the year, that comes out to 4,700. And if you divide the fourth quarter purchases, that's 1,200 by the total for the whole year, no matter if it's 5 or 7 year. Remember, this is all the personal property bought during the year. You bought less than 40% in that last quarter, meaning you're going to use the half year convention. This table here. In other words, the computer, you're going to take 20% rate in the first year, 32% in the second year. The machine, you're going to take 14.29, and this rate here, the second year, and so forth. Okay, so that's the half year convention. But let's assume the two dates are flipped. You bought the big asset, this machine, in the last quarter and the computer in the first quarter. So if you divide the fourth quarter purchases by the total for the whole year, you can see that fourth quarter is bigger than 40%. So now you know you got to use that mid-quarter table. So let's go back to that mid-quarter table. So the computer was bought in the first quarter, and you're going to take 35% in the first year, 26% in the second year. That machine that was bought in the fourth quarter, 7-year property, look how small, 3.57% in the first year, but then 27.55 in the second year. So that's calculated right here, those two percentages, yeah? And here would be the total depreciation for the year, assuming the mid-quarter convention is applied. Real estate, not personal property anymore, but things like building and things sitting on the land, like a parking lot, retaining walls. The convention we use is not half year or mid-quarter, but we look at the middle of the month that property was placed into service. Keeping in mind again, we don't depreciate land, but we depreciate everything on top of the land, the cost of those items. And we have two broad categories of real property. One is where the real property is used for people to live, their residence, like a condominium apartment, even single family homes that are rented out, and non-residential property, in this case after 1993. So this one probably don't apply anymore, yeah? So we're just interested in these two um, lives. 27 and a half years for residential and 39 years. Again, non-residential would be an office building, a barn on a farm, a warehouse, again, non-residential. And the depreciation rate tables is not using double declining, but the straight line method. So here is residential for 27 and a half years. And notice the numbered columns here. It goes all the way out to 12 months. So if you bought a condo in April, in the first year, you take this depreciation rate and you multiply it by the cost of the improvements to building. Again, you don't depreciate the land costs. Then the next year, you just move down this column. You stick within this April month or April column and use this as your annual depreciation. Notice how it's kind of steady for the rest of its life, because that means it's straight line all the way through 27 and a half years. In the case of non-residential, we're using even a longer life, 39, but the bulk looks like 37 years. It stays at the same rate. Again, you're going to have 12 columns to match up with the month you buy the asset. And once you identify the month, let's say March, you stay with that column for the rest of the life of that asset for its depreciation rate. Example, we have a warehouse. The total cost of the land in the warehouse is 170,000, of which 120 is allocated to the building. We would like to have as much allocated to the building cost to get a bigger depreciation. But something has to be allocated to the land. It's worth something. That's not depreciable. It just sits on your accounting records until you sell that property. You get to deduct it at that time. We're told this building was bought in July. So you assume you bought it right in the middle of that month. So I take a look at my warehouse. That's non-residential. Non-residential. July. I take this rate for the first year and multiply it by the cost allocated to the building and not to the land to get your annual depreciation for the first year. And you stick with that July column and move down to the next row for the future rates for future years. I'll continue with the next video with this topic of immediate expensing or section 179. So let's stop here.